You see Bitcoin crashing, and every instinct in your body is screaming at you to buy the dip. That little voice in your head whispers that this is the golden opportunity, the one chance to get in before the next rocket ship to the moon. But what if I told you that acting on that instinct right now is a trap? A perfectly laid trap that could wipe out your portfolio before you can even blink. The entire market is holding its breath. Retail investors, just like you, are getting ready to pour their savings into this drawdown, but most of them are about to make a huge mistake. They're buying the dip when they should be waiting for confirmation. There's a massive difference between the two, and that difference can mean financial ruin or the kind of wealth that changes your family's future. In this video, I'm going to cut through the noise, the panic, and the hype. I'll give you the exact data-driven signs you absolutely must see before you even think about putting another dollar into Bitcoin in 2025. These aren't opinions. They aren't guesses. These are the signals that have historically separated the smart money from the dumb money. By the end of this, you'll have a crystal clear framework that turns your fear into a strategic weapon, making sure you don't get trapped on the wrong side of this violent market. Let's level you up so you can navigate this bull run like a pro, not like someone else's exit liquidity. So how did we get here? It feels like just yesterday the market was pure euphoria, because it pretty much was. To understand the danger and the opportunity in this crash, we have to understand the context. The market just came off a euphoric rally in October. Bitcoin was on a tear, touching levels that had analysts calling for a straight shot to new all-time highs. We saw the price flirt with that psychological $126,000 level, and it felt unstoppable. The greed was so thick you could taste it. Everyone was a genius. And then November hit. The market didn't just tap the brakes, it slammed into reverse. We've just been through a brutal, gut-wrenching correction. We're talking a staggering decline that wiped tens of thousands of dollars off the price of a single Bitcoin. A 36% haircut from that peak, dragging the price from over $126,000 all the way down to the low $80,000, has left a trail of liquidations and shattered nerves. This wasn't a gentle pullback, it was a violent deleveraging event. The sentiment has flipped completely. The fear and greed index, which was pegged at extreme greed just a few weeks back, is now flashing signs of serious fear. The confident to the moon tweets have been replaced by panicked questions. Is the bull run over? Was that the top? Should I sell everything? This is the exact emotional state where the worst mistakes are made. And to pour salt on the wound, we're seeing some troubling signs from the institutional side. The spot Bitcoin ETFs, hailed as the gateway for Wall Street, have seen massive outflows in November. We're talking billions of dollars being pulled from the market by the big players. While retail is thinking about buying the dip, institutions have been selling into it, taking profits. That should be a giant red flag for anyone paying attention. This isn't just a blip, it's a major rotation of capital that's adding fuel to the fire on the way down. This creates the ultimate dilemma. On one hand, you hear the old saying, be greedy when others are fearful. All this fear must be a buy signal, right? But on the other hand, the data shows the big money is heading for the exits and the trend is violently down. You're stuck between the fear of missing out on a bargain and the fear of catching a falling knife that could chop your portfolio in half. This is why we need a plan, an emotionless, data-driven strategy. This is why you don't just blindly buy the dip. Instead, you wait for confirmation. You wait for the market to prove that the worst is over and that a real bottom is forming. And that proof comes in three critical signs. Let's break down the very first one you need to see. The first and most crucial sign has nothing to do with news or what influencers are yelling about. It has everything to do with the chart itself, the raw, unfiltered story of price and volume. Right now, that story is one of severe damage. Buying here is like trying to jump onto a speeding train headed off a cliff. You don't buy a broken market, you wait for it to heal. And that healing process has three specific parts. First, we need to see Bitcoin reclaim its key moving averages. Think of averages like the 50-day and the all-important 200-day moving average as the market's vital signs. When the price is trading comfortably above them, the trend is healthy and strong. When it crashes below them, as it has now, the market is wounded. During recent bull phases, Bitcoin has consistently used these moving averages as a springboard for the next leg up, but this recent crash sliced right through them. So, the first step isn't just for the price to stop falling. That's not enough. We need to see the price fight its way back up and decisively reclaim these levels. I don't mean a quick spike on a daily chart. I mean multiple consecutive daily and ideally weekly closes above the 200-day moving average. This proves buyers have absorbed the selling and are strong enough to push the price back into healthy territory. Until the price is living comfortably above its key moving averages again, you are in a danger zone. Don't try to front run this, wait for proof of strength. The second piece of the puzzle is a clear bullish divergence on our key momentum indicators, like the relative strength index, RSI, and the MASD. Don't let the names scare you. What they do is simple and powerful. They measure the momentum and strength of the trend. What we're looking for is a pattern called bullish divergence. It's one of the most reliable bottom signals out there. It looks like this. The price of Bitcoin keeps falling, making a new lower low. But as the price hits that new low, the RSI or MACD indicator makes a higher low. Let me say that again. The price goes down, but the indicator measuring momentum goes up. What does this tell us? It signals that the downward momentum is running out of gas. The selling pressure is getting weaker even as the price itself takes one last dip. It's like trying to hold a giant beach ball underwater. You can push it down one last time, but the upward pressure is building so much that the momentum has already started to turn. It's a huge clue that a trend reversal is coming, and it's often a violent one to the upside. Finally, the third component is establishing a new durable support range. After a huge drop, the market is chaos. What we need is for that chaos to turn into order. We need the price to stop making lower lows and start carving out a clear floor. This is a price range where time and again buyers prove they are willing to step in and defend that level. We might see the price dip down to say the $85,000 zone and get bought up. Then it might rally a bit, fall back to that same zone and get bought up again. And again, this process is critical. It proves to the whole market that the sellers have finally run out of steam at that price. It shows that supply is exhausted and demand is now in control. Only when you see this new support base being built and defended over days or even weeks can you be confident the downtrend is over. It's the market building a foundation for its next move up. Without that foundation, any bounce is probably just a dead cat bounce, a temporary relief rally before the next painful leg down. So, to recap our first major sign, you need all three of these things to happen. Price reclaims and holds above its key moving averages. A clear bullish divergence appears on the RSI or MACD, and a new support range is established and defended. When you see all three, the market's technical structure has healed. Only then can you start to think the bottom might be in. All right, if you're finding this breakdown valuable and you want to navigate this market with a clear, data-driven plan, do me a favor. Hit that subscribe button and turn on notifications. My whole goal here is to give you the actionable insights the pros use so you can protect your capital and crush your goals. It's free and it ensures you won't miss the critical updates I'll be sharing in the coming weeks. Go on, click subscribe. I'll wait. Now, let's get into the second non-negotiable sign. Sign number 2. On-chain data must show smart money accumulation. If the charts tell us what is happening, on-chain data tells us who is doing it and why. This is our secret weapon. It lets us look past the price and peer directly into the behavior of different investors on the Bitcoin blockchain. Are the veterans and whales selling with everyone else? Or are they quietly using this crash to accumulate more Bitcoin from fearful hands? The second sign you must wait for is for the on-chain data to confirm that the smart money has stopped selling and started aggressively buying again. This also has 3 parts. First, we need the MVRV score to cool down. It sounds complicated, but just think of it as a valuation thermometer for Bitcoin. It measures the difference between the current price, market value, and the average price people paid for their coins, realized value. When the score is in the red zone, the market is overheated and overvalued. When it's in the green zone, the market is undervalued and in a prime buying zone. Think back to early 2025 when things were heating up. The MVRVZ score was climbing into the 5 to 6 range. That was hot, suggesting lots of profit, but it wasn't in the final blow off top territory. What we need to see during a correction like this is for that thermometer to cool off. The sign we're looking for is a significant drop in the score. It doesn't have to hit the generational buy green zone, but it needs to reset. A drop back towards the 3 or 4 level would be a very healthy signal, showing that the short-term speculators have been flushed out. You want to buy after this reset, not while the market is still historically overvalued. Second, and this is so important, we need to see the whale wallets, the big players holding 100 to 1000 BTC, start stacking sats again. Throughout the first quarter of 2025, we saw these large holders accumulating, but they also sold as the market got hot. The sign we're looking for now is a clear reversal. We need to see the net position change of these wallets flip from negative selling to positive buying, and not just for one day. We need a sustained period of weeks where the total balance of these whale wallets is clearly going up. When you see that shift, it's one of the strongest confirmations you can get. It means the smartest money with the longest time horizons is confidently buying the fear. You want to be buying alongside them, not selling to them. Third, we need the Puell multiple to signal that miner selling is ending. The Puell multiple is a thermometer for miner profitability. When it's high, miners are very profitable and are likely selling Bitcoin, adding pressure to the market. When it's very low, miners are struggling to cover costs. This pain forces the weakest miners to shut down and sell their Bitcoin holdings to stay afloat, a process called miner capitulation. This creates a final intense wave of selling that often marks market bottoms. Historically, a reading below zero point 0.9 has signaled minor stress. The sign we're looking for is a 1-2 punch. First, we see the Puell multiple dip into that low stress zone. But you don't buy yet. The real signal is seeing it bottom out and start to rise again. That tells you the weakest hands have been flushed out and the forced selling is likely over. So let's put sign number 2 together. It's a 3-part on-chain confirmation. The market's valuation cools off. MVRVZ score drops. The whales start buying again, and the minor capitulation ends, Puell multiple bottoms, and recovers. When these on-chain metrics align, you can be confident the market's internal dynamics have shifted back in favor of the bulls. Even if the charts look great and the on-chain data is bullish, one thing can trump it all: the macro environment. Bitcoin doesn't exist in a vacuum. It's a global macro asset, and the biggest driver of all risk assets is liquidity, which is mostly controlled by the US Federal Reserve. So the third and final sign is the all clear from the macro world. This also has 3 parts. First, the Fed must confirm its pivot to easier policy. Let's be very clear. When the Fed raises interest rates, it's poison for assets like Bitcoin. When the Fed cuts interest rates, it's rocket fuel. Right now, heading into the end of 2025, the market is pricing in an overwhelming chance of a rate cut at the upcoming December FOMC meeting. But here's the trap. That is just an expectation. The market has been wrong before. The sign you're waiting for is official confirmation. You need to see Jerome Powell at the podium and hear the words from his mouth. Either they announce a rate cut or give unambiguous guidance that one is coming. Until then, you are taking on massive risk. If the Fed stays hawkish, they will pull the rug out from the market in a second. Don't bet on the rumor, trade the news. Second, the US dollar index, DXY, must be in a confirmed downtrend. There's a strong inverse correlation here. A strong dollar is a headwind for Bitcoin, and a weak dollar is a massive tailwind. A falling DXY signals a risk-on appetite. As capital flows out of the dollar and into other assets like Bitcoin, we need to see more than a one-day dip. We need a clear technical breakdown on the weekly chart, a pattern of lower highs and lower lows. If you see Bitcoin trying to rally while the DXY is also screaming higher, be very suspicious. That usually doesn't end well for Bitcoin. Finally, we need a sustained reversal in the institutional ETF flows. The spot ETFs are the main fire hose for institutional money into Bitcoin. Their daily flows are one of the most transparent indicators of institutional sentiment we have. As we saw, the November crash was made worse by massive outflows from these ETFs. For a true bottom to be in, this trend must reverse. A single day of small inflows isn't a trend. The sign we're looking for is a sustained week-over-week trend of net positive inflows. We need to see hundreds of millions or even billions pouring back into these products week after week. This is the ultimate confirmation that the largest pools of capital are repositioning for the next leg up. So our third sign is the grand macro confirmation. The Fed officially pivots, the dollar breaks down, and institutional capital comes flooding back into the ETFs. When you see this macro trifecta align, the stage is set for a truly explosive rally. Now, it's worth quickly touching on the bedrock of this entire market cycle, the Bitcoin halving. This is a pre-programmed event where the reward for mining new Bitcoin gets cut in half, creating a powerful and predictable supply shock. The next halving is on the horizon, with projections pointing somewhere in 2028. It's important to know that there's no single agreed upon date this far out. Estimates vary from March to June of 2028, depending on the source and real-time network speed. The key takeaway is that we know this powerfully bullish supply shock is coming. It's a long-term tailwind. However, and this is critical, the halving narrative is a terrible tool for short-term timing. It tells you nothing about when a brutal 40% correction will start or end. That's why you must rely on the 3 data-driven signs we've covered today to manage your risk. The halving is the wind in our sails for the long journey, but our 3 signs are the instruments we use to navigate the storm right in front of us. So let's bring it all home. You're tempted to buy this Bitcoin crash. You've got FOMO, but you're not going to act on that emotion. You're going to act like a professional. You're going to wait for confirmation. You are waiting for 3 non-negotiable signs. Sign number 1, the technical structure heals. price reclaims key moving averages, we see bullish divergence, and a new support base is built. Sign number 2, on-chain data shows smart money accumulation. The MVRV Z-score cools down, whale wallets show clear buying, and the PUL multiple shows miner selling is exhausted. And sign number 3, the macro environment gives the green light. The Fed officially pivots, the dollar breaks down, and big money starts flowing back into the ETFs. Don't just buy the dip, amateurs buy the dip, professionals buy the confirmation. You will wait patiently for these 3 signs to align. It might take weeks. It might take longer. But patience in these moments is what separates the winners from the losers. Let the market prove to you that the bottom is in. Don't try to be a hero and guess where it is. Now, I want to hear from you. What other signs are you watching? Do you think the bottom is in, or is there more pain ahead? Drop your thoughts in the comments below. I read every single one. And if you want more deep dives like this, make sure you're subscribed with notifications on. I'll see you in the next video.